right, good morning, good afternoon, good evening, everybody. Today is Wednesday, September 30th, 2015. It's 12:04 Eastern Time. My name is Jerry First, founder and director of Investors Education Network, otherwise known as Traders Education Network, broadcasting on capitaldiscussions.com. We are going to start our trading group for beginners. And for those of you in the room, would you please go ahead and let me know if you can see the current screen, which currently is a PowerPoint slide for capital discussions. And I'm going to go ahead and shift real quick for a second over to a chart. And you should be able to see a chart of Apple with a whole bunch of squiggly lines on it. So if just want to make sure that we have a sound check and a visual check. Can everybody see that okay? All right, very good. Thank you, Mr. Smith. So we'll go ahead and we'll get started here. Here at Capital Discussions, there's several different trading groups, and so all of this is strictly for educational purposes only. Nothing should ever be considered as an suggestion or advice to trade. And it's in general, whenever I find somebody who's a cheerleader for a specific position, I get a little squeamish. I've been doing this for a long, long time. I started Investors Education Network over 12, 13 years ago after attending scores of workshops and seminars before and after forming it. Going back, anybody remember the Wade Cook days? And so what I want to do is make sure that we have some participation, and for some of you who do have experience, or even if you want to go ahead and get more experience, what I've found overall when it comes to learning how to trade, it's a practice. Notice that when you have lawyers and doctors, they always say they have a practice because it's always changing. When it comes to trading, it's an art and a science. We have tons of software that's constantly changing. We have the markets that are constantly changing, and the fundamentals built into the markets are constantly changing. One of the examples being that a long time ago, we were using fractions in order to trade stocks. And for those of you who remember trading with fractions, you had the bid-ask spread, which was how your brokers were getting paid. And to put in a live option trade back around 2000 would cost you quite a lot of money. And just to get a real live quote, either you needed a lot of money in your account or you'd have to pay for real-time feeds, a lot of the things that we take for granted now. So I just want to go ahead and we'll get started. And basically the foundations with the basics. If you're going to invest in trade, okay, we can do day trades, swing trades of 1 to 4 weeks. We can be doing investing for the long term. We can buy and hold for a long time and trade around that position with intermediate day trades and swing trades. Or we could go ahead and start taking other types of trades, such as earning announcements. For example, that would be one example of a strategy. And one example of a strategy here being the fact that if we were going to work on earnings announcements, you have like the 3 weeks or about a month before, as you have implied volatility starting to rise. You have the day before earnings, the day of earnings, and the day after earnings. And each one of these situations requires a different level of strategy and skill and expertise as far as entry, exit, and adjustments. There are some people out there that just love to focus. I'm going to pick on the condor traders. They just love iron condors or whatever. And the brokers love iron condors because you have 4 legs and a lot of adjustments. And it's It's a long, slow burn before you go ahead and make a little money, make a little money, make a little money, and then you have one trade that blows it out and has what's called a 3 or 4 standard deviation move, and then you give it all back. And so the bottom line is when it comes to the basics, and this is all, my experience, been doing this for a long time, is that everybody has to come up with their own strategies that they're comfortable with. And my whole purpose is to help people learn how to do it themselves and to come up with their own comfort level, and not so much to look for someone to hand them the fish to eat, but to go ahead and give them the fishing rod and the bait and the fishing hole to go out and try and find their own trades. And so part of the basics, what and when to trade, and maybe more importantly, when to stay out of the way, when to stay out of the market. And for those of you who are beginners, we are currently right this minute in the middle of what could be a major market pullback. We've been long overdue for just a general pullback, just a regular retracement, which we got about a month ago. We got about a 10% pullback. And now the question becomes, are there going to be real fundamental reasons and ripple effects for that to turn into potentially a 20, 30, 40, 50% or more crash versus correction? We've already had what I'd consider to be a healthy quarterly pullback and rotation. And so now the idea is, okay, what's going to happen now? Because we do have a lot of things on the plate. Any questions so far? When we are looking to go ahead and get in and out of the market, I am considered to be a chartist and technical analyst, and I also use the fundamentals and look for scheduled events. If it's in general for the indexes, I'd be looking for, such as this Friday, we have non-farm payrolls coming up, GDP announcements, other types of potentially scheduled events on the calendar that can make the markets have an excuse to move. Unscheduled events also, such as we have on our TV screens right this minute, where you have Syria intervening, or I should say Russia intervening with Syria, telling the U.S. to get out of the way, and you're sitting on potential powder cakes that could explode in the Middle East, that could affect oil and the commodity markets, and you can see the ripple effects with Glencore potentially defaulting, with credit default swaps that could blow up. And then you also have on C-SPAN right this minute cybersecurity hearings, where I'm seeing a whole bunch of people who are entrusted with our security here, not just in the U.S., but around the world, that they don't even really know what type of communications equipment their subcontractors are using, whether or not that equipment's made in China or somewhere else. The reason for that is that when you have potentially unscheduled events, you have potential for market manipulations, shutdowns, or what some people might say, the markets will say that they're in need of self-help, when the markets need to go ahead and either shut down or fix a technical issue. And so you don't want to be in and out of trades when there's technical issues in the markets, and I've seen it. Everything is great until all of a sudden there's huge volatility in the market, and if you're not prepared, and if your broker isn't prepared, all kinds of strange things can happen. So when we're going to go ahead and trade, we have our option of using indexes and index ETFs and ETFs versus futures. There's pros and cons to using ETFs, which trade like a stock on a regular 9:30 to 4 p.m. Eastern Time schedule currently, I would make an assumption that probably within 5 years or so, sooner or later, we'll be trading on a much larger time frame that probably mimics the futures markets within the equity markets. But for now, if you want to trade 24 hours a day, around the clock, you've got the futures markets, and then you have futures on options. So it all depends on, do you trust your futures broker, such as the people who clear through Glencore currently are a little bit nervous. And people used to trade with MF Global and PFG and Refco, for those of you who've been around a while. If you don't know who Refco is, or MF Global, then you haven't seen what's potentially coming your way if you are trading futures. Index ETFs, this is where the general public en masse have their accounts. And so when people open up futures accounts, they sign away quite a lot of rights and are expected to be sophisticated investors. And so if you trade in the futures markets, your rights are not quite the same as index ETFs. And you might say, what you might not believe it, but if you had an account or know of someone that had an account with MF Global or PFG or Refco, their accounts got closed, shut down, their trades were shut down, they were frozen out, and maybe if they were lucky, they got 30 cents on the dollar back for their account. So that's why I stick with the ETFs in the indexes on a high level, indexes being the S&P 500, NASDAQ, Dow 30, Russell, and then you have the sectors inside of it, biotech, healthcare, insurance, oil, retail. And then you have the individual components inside of those sectors. You can have leading and lagging components. So the idea is, number one, if you're going to start to trade, and this is the basics, this is the foundations, what and when to trade and when to stay out of the way. Number one, you have to go ahead and think of it as surfing. If you're a beginner surfer or skiing, if you're a beginner at skiing or a beginner at surfing, are you going to just, jump on the huge waves out in the middle of the Pacific? Are you going to go ahead and put on your skis and take the expert tracks, or are you going to start off on the bunny trail? If you decide to go ahead and go all in, as a lot of beginners do, a lot of them get hurt very quickly, and then they walk away wounded and say, oh, I tried that, and that's really risky, and I got hurt. When it comes to investing and trading, especially with options, it takes experience, and it takes time, and it takes skill with computers and charting and technicals to go ahead and figure out some of the main points and the main components. You've got time, price, and volatility that make up the options markets as far as the variable formula as to how options are priced. So this is a chart of the Dow 30 as of Monday's week ahead webinar that I do. And so we have where it looks like we're in somewhat of a correction mode. We have broken support levels, and it looks like we could be moving further down. That was on Monday. What does this chart look like now? Let's go ahead and I will open up the same charts. Hold on a second. Go ahead and type in your questions in the meantime. If you have any questions, type them on in. while we're waiting for that to load up, when it comes to resources that you might want to use for scanning for opportunities, as well as getting your finger on the pulse of the market, stockcharts.com, which is John Murphy's website. John Murphy, well-known, renowned technical analyst, market strategist, has written a fantastic book that encompasses a lot of topics that you would need if you wanted to become a technical analyst and expert. He's got this site here, and if you go to the free charts tab, and if you click on the Dow 30 components, you'll get this page, which you can go ahead and set to either a 2-month period, 6-month period, or a 1-year period. And so with this, and by using my control minus, I can go ahead and shrink all of those charts down onto one screen. If I want to go plus, I can zone in a little bit closer. So for those of you who are not really aware of the browser functions of minimizing and maximizing your screen, magnifying control minus and control plus does that. For those of you just, getting started with me, Jerry First, I got started with computers working at IBM way back in 1980. Was working in Boca Raton, Florida when they first released the IBM personal computer on the market. And so when it comes to computers, I've merged my passion for technology and my knowledge of computers and my passion for the markets and put it all together. And so I do coach and train people one-on-one, and I do teach occasionally small courses of people. And here on Capital Discussions, we've been discussing having a paid course on charts and technicals. You can consider this session here kind of like a window into how I, discuss the markets, some of the resources that I use. And if you want to shorten your learning curve, feel free to contact me on the website, which is traderseducationnetwork.com. And you can go ahead and click on the top banner up here for private coaching and mentoring and get a free 30-minute trial period with me one-on-one. You've got at least an hour right here today with me. So consider that to be, for all of the speakers here on Capital Discussions, sometimes we take for granted the efforts that a lot of us go through to provide education. And there's a lot of cynics out there even that'll say, if you're so good, why are you teaching? And you forget to go ahead and thank the teachers that actually enjoy teaching and the teachers that believe that when I'm teaching, I'm getting stronger and better and also being disciplined. And it's also taking away time from me, missing out on market opportunities and all the other people that are doing this. So just, go ahead and remember to thank your teachers, whether they taught you how to read English or how to read charts and graphs, or whether you're trying to learn something such as option view, or you can go ahead and work with something as complex as options. I got my start trading my own account after I cashed in some of my IBM stock back in 1987, just before the market crashed. Opened up a self-directed account with Schwab and have been actively managing my own accounts ever since. And so I started trading options around 1999. I started getting involved, understanding the basics of calls and puts. And by running Investors Education Network, taking over a small trading group in 2002, as most of these little groups get started and then the leaders figure out that it's not worth their time and energy, I was invited to partake in so many workshops with so many of the experts in the field, people that I've taken courses from: John Carter, Hubert Centers, Steve Neeson with candlesticks, Steve Bigelow with candlesticks, um, John Person. Uh, I mean, the list goes on and on. David Elliott, who's passed on. Uh, a lot of the people who are, I've met and participated in workshops and seminars with people such as John Murphy and John Bollinger, and and so when I go ahead and I'm sitting elbow to elbow in a classroom or having a beer or having breakfast or dinner with some of the other traders and some of the biggest names in the business, and then I'm happy to go ahead and share my knowledge. But it's interesting. People bring their biases with them, and so you have to go ahead and figure out what works for you. And so one of the things that works for me is this screen right here, which comes from dailyfx.com. And for those of you who have never seen this before, this is my 3x3 grid that I still use. I used to trade and invest with currencies before the NFA and the CFTC changed a lot of the rules. And rightfully so, a lot of the Forex brokers were trading against their clients. But what I do is I keep my finger on the pulse of the global markets by watching the euro in the top left, the pound in the top middle, and the dollar yen over here. The center row, I've got the S&P 500 with the US Dow 30 underneath that. I got the dollar index in the center square for Paul Lynn there. And we got the U.S. oil index over here, trading currently. This is West Texas at 45.30. And we've got gold over here in the bottom right, and we've got the Aussie US dollar over here. And so I'm watching these global currencies. Interesting, I watch for chart patterns, and what sticks out to me right this minute is that we have a triangle pattern setting up on oil, which is interesting because we do have a potential global issue right now with Syria. And for those of you who really, what the hell does Syria have to do with anything? It has a lot to do with a lot of things. Primarily the fact that you have oil fields discovered out in the Mediterranean. You've got pipelines that are being manufactured to transport oil from Iraq over across through Turkey. And all of this is, all of these global issues will show up on your charts. And for people who wake up on, let's say, September 11th, 2001 and say, what the hell happened? Other people will say, well, didn't you see it coming? And so being prepared, being knowledgeable, not being naive about the global world that we live in. If you're going to trade in the financial markets, realize that all of these squiggly lines represent a lot of money flowing back and forth, and you can see the correlations that are taking place. So right here, you can see the daily chart on oil, and we've got this a pretty nice triangle. You could call that a flag pattern as well if you wanted to. If we break above the resistance up here at about 46.30, price of oil could start to spike back up to 49 and 50 and higher. If we break the support level, okay, if we break below the 43.80 or call it 44, if we break below there, we could be making double bottoms. We don't know. Sometimes what sounds obvious fundamentally, like, well, of course oil should go up. We have major potential problems in the Middle East. But then again, you have Glencore imploding because of all kinds of other issues. You can go crazy trying to follow the fundamental reasons why something is or isn't going up, such as gold. There's a chart on gold. Now you might say, this is a beginner's trading room. What does gold have to do with trading? Well, Gold is a currency, and you can trade gold by using the GLD. But the idea is you should look, or at least I look, and I want to know what is the price of gold and the trend of gold. How is that reacting in correlation or non-correlation to the other major components of the markets? So at this point, what I'd like to do is, what is U.S. dollar made of? Robert's asking question. The U.S., great question, Robert. The U.S. dollar index is a basket of currencies, typically about 6 to 9 currencies, and it's just like the U.S. 30 Dow index is made up of 30 stocks, and the S&P 500 is made up of 500 stocks. You have the three major pairs, which is the euro, the yen, the pound, the Australian dollar, Canadian dollar, and then you have some of the minor currencies that get, pushed in and out, just like the Dow 30 and the S&P 500. There are people and the brains that are behind the scenes. They pull the stocks in and out of the S&P 500, and they pull the winners and losers out of the Dow 30. Same thing with the dollar index. The Russian ruble versus the Brazilian real and the the Australian dollar will have different weighted portions of the dollar index based on the committee that goes ahead and puts that dollar index together. I don't get stuck in the weeds of that. One of the things, now we're talking about being beginners, one of the things that I tell a lot of people is that sometimes the best trade that you may ever make is the trade that you don't make. And if you can realize that maybe trading is really not for you, one thing that I tell some people is that just by going ahead and using the ETF on the Dow 30 or the S&P 500, those are the brains. Hedge fund managers are always gauging themselves against what? They're gauging themselves, did they or didn't they beat the market? And so the S&P went up, 14, 20, 30% over the last individual years or whatever. And the hedge fund managers are always trying to say, oh, I beat the market, or I, kept pace with the market. If you just want to keep pace with the market, you want to open up your own fund, just go ahead and pick up an ETF on the Dow 30 or the S&P 500. Here's on option view. I've got one of my tabs below here on Dow 30. You can see the Dow index is trading at, what is 16,000? Let's go back to our chart here. We're trading at 16,180, okay? And you can see that option view has it option view has it, the decimal point is off. It's 161.86. Notice that we have the DIA ETF for the Dow 30 is 161.63, and it's almost identical. You've got the Russell index over here. Notice it's up 7.43. And you've got the IWM, which is the Russell 2000 ETF, trading at 108.40. It's not exactly a one-to-one correlation, but it's close. Here you've got a 7-point move. This is a 0.8 move, but you've got just a fraction of the exposure. You can do the same thing with the S&P 500 with the SPY ETF. Or if you want to trade the euro, one of my experiences that if you want to trade within the euro currency, the currency brokers would love to have you trade for 10 pips in and out several times a day until you blow up your account. The successful traders will be working with much longer term positions. And so going to go ahead and delete all these drawings here. And so you can see that right now the euro has pretty much got a pretty solid resistance level right here, triple tops on this resistance level. And you've got a pretty solid parallel line here. So you've got this trend channel. We're in the middle of it, a little bit towards the bottom portion. Zone in a little bit. And we could be seeing gravity pulling the FXE, the euro, down to 108.52 from 109.56. Now, if you were trading that in pips on the actual currency, that would be a huge move. And the odds are that your account wouldn't be able to hold that. I know I still get a lot of people that ask me to teach them about Forex and currencies, and I really go ahead and say, look, why don't you just trade the ETF? It's a lot safer, it's a lot calmer, you can sleep throughout the night, trade the chart patterns, and that'll help you out. But, so that's, we have our options of trading in the equity markets, the futures markets, commodities, oil and gold, and the currency markets. So let me go ahead and open it up to questions a little bit. What are you interested in trading in? And what are you interested in learning? This is the Capital Discussions Beginners Trading Room. So this is our first session, and we need participation. And we're a small group. Don't be shy. If you're not familiar on how to use the chat, I don't know if you can see the screen. I think it's grayed out, but you move your cursor to the top of the screen, move your cursor over to where the chat option is, and once you open up that chat box there, you go ahead and just take out your keyboard and start typing stuff in. And you don't have to worry about being politically correct. Just go ahead and start typing. And we'll take it from there. And let me take a look. And I'll just sit back and wait until I get some questions from the audience. I really enjoy the audience participation. Been doing workshops and seminars. Like I said, I've been conducting them, coordinating them. I've been on the same stage as Tom Sosnoff over at the Marriott Marquis in Times Square and Mandalay Bay over in Las Vegas, and as an invited speaker to the Traders Expos. I do the Week Ahead webinar here on Capital Discussions every Monday at 12 noon. And just to go ahead and, let you know that I'm not just a beginner at this thing, but, I spend my own time and money, and my passion is with the markets. And so this is me sitting inside the Board of Governors room in Washington. This is Ben Bernanke over here and his assistant. And this over here is Deputy Director of the IMF back a few years ago. This is me sitting inside the Board of Governors room at the table. That's not really the head of the table. The head of the table is usually in the center section over there, but that is up at the head. Nice big screen over there inside the Board of Governors room where they decide the interest rates and figure out how much quantitative easing they may or may not pump into the market. And that's a fireplace right behind me where they can go ahead and burn the evidence. And this is Mr. Shepard over here, President of the U.S. Chamber of Commerce. Let's see, we got a question here from Norman, or a statement. In my 70s now, so no longer it's no longer a viable strategy. My first stock purchase was when I was in the 7th grade. It's great for many decades. Now I'm interested in learning when to stay out of options and how to hedge positions. Okay, excellent. So I'm also on the board of directors of South Florida chapter of American Association of Independent Investors, and the president of the local chapter down here doctor, former doctor, he was explaining that his, I think his seventh grade teachers, coincidentally, had them do like math exercises by studying the stock market. And his parents, he had zoned in, I think, on General Electric, and his parents went ahead and took some money and bought some shares of General Electric way back when, and that helped fund his college tuition and buying his house. And when he needed to buy a house, he sold the shares to his parents, and when they passed away, he got the shares back, and that helped fund his children's college tuition and well into the retirement. And what's very sad, Norman, is that it seems as if we're in a different world today. I grew up in New York. I several field trips in New York Stock Exchange. Used to see scores of people ankle deep in trade receipts on the floor of the exchange, and now we just have leveraged buyouts and such, and so the opportunities of just buying something like a Google and holding it forever don't necessarily work the same as it used to, where now we have companies like AOL and BlackBerry, and for all you know, Apple will come and go. So anyway, so Norman's asking, he's interested in learning when to stay out of options and how to hedge positions, okay? Two very good questions that we can get into. And Robert's asking, he's thinking of working on he's working hardest on is being consistent and not taking myself out of trades, mostly not getting in. It's amazing the excuses I come up with. Okay, very good, Robert. So your point is on the psychology of trading, and it sounds like both of you, not really beginners as much as just wanting to continue to learn more and participate. Once you understand the technical aspects of trading, so let's go ahead and, for example, these are the 30 Dow components, okay? And let's say that if I wanted to just look at the Dow 30, the chat panel isn't showing all participants option. Don't know. All participants. Let me see if there's something that I can, is there something I can adjust? All participants option. I don't know how to adjust that. For some reason the chat panel isn't showing an all participants option. Send to all, oh, okay. So when you send not a big deal. Got it, okay. There may be a switch on my side. I don't know where Tom is. I'm used to using WebEx, not WebEx, some of the other platforms, and so I'm not a WebEx expert here. Okay. We can blame it on Tom always. Tom does a great job. It'd be nice if I did get some more support from Tom and Jim kicking off the first meeting, but then again, not a big deal. So all right, so take a look at my chart here on the Dow 30. All right, so the idea is, okay, once you learn how to use your charts, once you learn how to come up with support resistance zones, like Amazon, for example, I'm working with a client that wants to get involved with Amazon. I've got support and resistance zones. What about GoPro, for example? Okay, you've got support and resistance zones. Is GoPro oversold? Is it, good time to buy? Do we sell support? Where's the next level down? These are the technical aspects of trading that you have to master so that you can get up and run quickly to make a decision when you think that there's a move that you want to take advantage of, or something you want to, whether it's Option Net Explorer or Option View, will give you an edge as far as figuring out what strategies to employ and which calls or puts to use and what your risk reward is. If you're doing it without these types of professional platforms, you're at a huge disadvantage, and the odds of you winning long run are much less. Doesn't mean you can't be lucky. There are some people just lucky. So what what Robert is mentioning is probably one of the biggest issues. Once you have mastered the software and you understand options and all of the different strategies, like if we go to Trade Finder and you have all the different verticals, backspreads, long and short butterflies and strangles and condors, and then you go ahead and start mixing and matching things so that you've got the the triple Lindy. Let's go ahead and bring up Mr. Dangerfield. The triple Lindy trade. Uh, it all becomes a level of you and your psychology against the market. And that's probably one of the best things that I help people out with, because by the time you're up and running, now, the hardest thing is that, let's say that you buy and get into a trade, you've already planned it out, and if you can stick to your rules, then you're going to be okay. But fear and greed will always kick in. And so just when you've got 100% gain and you're thinking that, it's going to go higher, that's probably the time you should have taken at least half off the table. Usually your gut will tell you to either get out or take something off the table, and try to listen to your gut. But, that's at a high level. As far as managing your positions in your portfolios, and to Norman's point, when to stay out. Okay, when to stay out is something that depends on your risk tolerance. Do you have what not to trade and when not to trade? Okay, so let's go ahead and open this question up. What are some of the things that would be a red flag about what not to trade? You can go ahead and type that in. And let's also go ahead and open it up. When is it a good time to stay out of trading? And so I want to thank you, Norman and Robert, for sharing and participating in the questions. And so I think that one of the concepts is, what's your time horizon and what's your level of risk tolerance? And what are your goals? That's what any financial advisor would ask. By the way, I'm not a financial advisor. I'm an educator and trader, and I enjoy, the markets and the movements and the opportunities. And so looking over here, this is the summer of 2011 when we had a government shutdown looming, and the S&P S&P downgraded the U.S. We had a huge run from the middle of July, and we crashed down into August before we bounced up and then came back down. Take a look at this chart. Try to memorize the pattern here, and then take a look and look at this pattern right here. Isn't it almost identical at the right edge of the chart? Huge move down followed by a run up. I mean, this is Monday's chart, and this is October of 2011, after the summer of 2011, where we had a huge run down. So the question becomes, is this an opportunity? For me, it was one of the best trading in my life. I was able to go ahead and participate in these moves, which were huge. And I was on the right side of the trade, leveraged properly with the proper strategies and tools. and I was able to trade quite nicely. In fact, I think, do I have, I think I've got, when the bear shows up, are you prepared? Because the bear can be awful friendly to the right trader who's prepared. And let me see here, blah, blah. This is my option view analysis going back to March through August of 2011, where I had a total of 42 trades during that time. And it would have looked even better if I would have narrowed that down between, let's say, July and 2011, but I wanted to show the entire, this was a trade I was doing under friends and family, where I put in $50,000 initially, and I brought it up to 132,000. Had 28 winning trades, 14 losers, 67%. And because I'm using spreads, option view at the time didn't really calculate the fact that those were spreads. But as far as largest winning versus losing trade, but you can go ahead and see that during that time, some fantastic trades. Here's an example of the death cross over here on the DIA back in September of 2011. Notice after the move down, and we were just kept on moving down, and just when you thought it was safe to get back in the water, it dropped down. I like risk-reward graphs that look like this, where you have the zero line. If you're going to be trading, you need to understand these risk-reward graphs, and everything below zero is risk, and everything above zero is potential gain. And so these are the type of trades where it's roughly a 1 to 3 risk-reward. And those are the kinds of trades where, as long as you are properly managing your psychology and emotions, you can go ahead and end up with trades like this, 100% gain in one day, where buying a spread and selling it the next day on autopilot, not worrying about the broker potentially having a problem, because I already put in my exit order by using option view, calculating the fact that I entered this trade on August of 2011. Notice we had several conditions technically. We have, I have magnets of 168 and 162 as price targets. I've got a 50-period moving average coinciding roughly at the same point as a Fibonacci support level, trend line support, and I was anticipating the breakdown with the negative bias of the market at the time, IBM trading at the time at 171. I had a target of 161. Using option view, I calculated that I could go ahead and do the 165, 170 September spread, and go ahead and I entered the trade, and it cost me $1.67 to enter it, and I had immediately put a exit order of $3.20, and the next day it was filled. And that, is something that where some people might look at the market and say, I'm going to stay out of this, the water's too rough. And if you're prepared for the risk reward, and if you're prepared for the volatility, it can be, the bear can be your friend. In fact, the bear can be a very, very friendly pet. But you do have to watch out, because those claws, if you get rough and tumbled with the bear, it could go ahead and hit you. Okay, so take a look at this over here. This is back during the crash in 2008, 2009. We had about a 57% decline from peak to the bottom. And over here recently, back in just about a month ago, we've only had about an 11% pullback. So let's go back and look at the live chart. And if we go ahead and make this a weekly chart and bring in a lot of data, Have we really pulled back that much? We have definitely broken the support level right here just by connecting. This is your basic support and resistance here. You go ahead, first of all, you bring in enough data so that you can see the inflection points and connect the bottoms to the bottoms and the tops to the tops. Next thing you know, old Jed's a millionaire. You got your trend channel, nice, symmetrical. And what I'm looking for is multiple touches of support and resistance, or something that's at least close. And right here, and it takes practice, ladies and gentlemen, to use the different software. And it's very easy for people, even myself, to get, I'm comfortable using certain charts and software. It's like, why would I want to learn another option analysis software? Even Thinkorswim, as good as they are with some of their software, which is free as a client, I still say that OptionView is worth every penny for some of the functionality and ease of use with the interface. And so if you want to learn, I don't know how many people here are using OptionView, or if you want to learn that, we could focus on that, or if you want one-on-one coaching and mentoring on how to use OptionView, how to use charts. Let's say that you're not familiar with, you've heard all about Fibonacci's and you just don't understand it. You say, yeah, it's a bunch of hogwash. Well, watch this. From this peak to this bottom, I go ahead and draw Fibonacci, and now instead of just guessing, I've got the 138.2 extension, which is pretty much called a support resistance level right up here, just above 17,000. And the 123.6 extension is where price is gravitating to. Is it precise? Is it exact? No. But I could zone in and drill down into a daily chart, and I could go from this low to this peak right here. And one of the key things about Fibonacci's is it's very subjective. The question I'll always get is, how do I know where to draw from and to? And so how do I know to draw from here to here versus from here to here? Or maybe even from, let's say that I leave that, okay? Oh, how'd that get there? And notice I've got a lot of Fibonacci extensions and retracements. Excuse me. So notice that right here on this daily time frame, this is on the Dow 30, we've got from this low of October 2014 to this peak of December 4th, 2014, we have support levels here, the 38.2 of 17,172. We also have the 123.6 level here. What I'm looking for is, are these retracements being captured? And in this case, they're not. I can click and drag this in this charting software, and then I can go ahead and bring this down and readjust, and just like a measuring tool. Now take a look at this. From this low over here at about 17,025 to this peak over here at 18,100, those are inflection points. Notice that the 50% retracement and the 61.8 retracement and the 38.2 retracement are all capturing inflection points. So that to me tells me that these are good Fibonacci's that are in harmony or in frequency. They're in tune with the chart. And so for those of you who think that's a little hokey, what am I talking about? Well, I can understand that. But the fact of the matter is all of these squiggly lines move in certain patterns. The Fibonacci's just happen to work in nature, and I encourage you to experiment with them and learn with them if you're new to Fibonacci's, or if you want me to help you, go ahead and go out to the Traders Education Network website. You can go ahead, in fact, I'll go ahead and I'll copy and I'm going to paste that in here. If you want to go ahead and get a free 30-minute consultation after I get a gauge as to where you're at. Otherwise, you can go ahead and tune in again next week, next Wednesday, for the beginner's trading room, and we can go ahead and explain a little bit more about how we can go ahead and figure out whether we want to trade the Dow 30 index future or the individual components, for example. We've got, let's see, Norman. For me, options allow intellectual participation, a small portion of total investments. Correct. Focused on the short term, typically aimed at principally theta, time decay plays, weekends before expiration week. These days, every week is expiration week, and that you see, that's another reason why the markets have changed. It used to be that expiration week was a big thing, and there were lots of trades that you could move into on Tuesdays and Thursdays of expiration. But now, if you're trading with anything of good liquidity, the odds are they have weekly options, and then every week is potentially expiration. But then there's strategies for weekly options versus your standard monthly options. Contraindications is lack of time to adjust in markets, becoming more volatile. So the volatility is your friend if that's what you like. If you like just calm, upward grinding markets, knowing when to get out, to answer your question, is just a simple break of the trend line. Once you had this break of the trend line, the idea is, okay, it looks like it's about time to be a little bit more nervous about the markets and wait until you get back above it. Another simple indicator to follow. Another simple indicator to follow as far as when to stay in or get out is the 8 exponential moving average. The 8 exponential moving average will typically go ahead and keep you on the right side of the trade. Norman's asking or saying put debit spread protecting and put credit spreads as an example. Okay, so getting into spreads and everything is a little bit more advanced than a beginner's, but we could go ahead and start to gravitate into that as we move forward. So that's definitely something that we could start to work towards. This was our first session here, a little bit more of a introduction of me and the fact that I'm working with the technicals, with the charts, going to be working with OptionView to go ahead and figure out what are the best trades. But initially, we'll be working with the verticals, horizontals, and diagonals for the most part. We might talk about collars and synthetics as far as using options instead of the stock, because obviously 1,000 shares of $100 stock potentially has 100,000 of equity at risk versus options, which could be a lot less. So with that, we are a couple of minutes past 1 o'clock. We started about almost exactly an hour ago. So what I'd like to do is say thank you for tuning in. And this is Jerry First here on Capital Discussions, telling you that you can tune in and see me every Monday at 12 noon for the Week Ahead webinar. And we're kicking off here the Beginners Trading Room here on Capital Discussions every Wednesday at 12 noon. So go ahead and tune in for that. Register and tell Tom and Jim to drop on in sometime. All right. With that, we're going to go ahead and end the recording. And you're welcome to go ahead and ask me any more questions for next couple of minutes, and then I've got to run. So that's the end of the session here. All right, very good, Norman. Thank you. Norman says, I use option view, but I'm far from comfortable with it. Also working on technical instruments like fibs would be helpful. Okay, excellent. So what I can do is, if you have specific questions on option view or technicals, go ahead and type them in the beginning of the session. And if you want to really, shorten your learning curve, feel free to go ahead and, click on the link above and fill out the survey, and we can go ahead and work specifically with you to speed up your learning curve and get you more comfortable. And like I said, some of my clients get the best best use of having a second brain that's unbiased. I don't have any ego in your trades. I'm not telling you to buy or sell a specific spread or a specific trade. So I'm not risking my reputation on that trade. So I can go ahead and help you with your trades and be your conscience as a guide. Not to tell you what to do, but I can tell you what I see and how I would use option view or my charts to potentially find out where support resistance is and maybe what the best options might be. But Norman, thank you very much for your participation. Anybody else have any comments, questions, concerns? Go ahead and type them on in, or you could go ahead and contact me directly at the link above. Fill out the survey form, contact info, and just type into the chat box, not the chat box, but inside the comment box, any of your specific questions and so forth. All right. Well, thank you, everybody. Have yourself a great rest of the week and have fun out there trading and investing here at capitaldiscussions.com. This has been Jerry First with TradersEducationNetwork.com saying have a great day. Bye-bye.